And he is the president of Yardeni Research, a provider of global investment strategies and asset allocation analysis and recommendations. He previously served as the chief investment strategist of Oak Associates, Prudential Equity Group, and Deutsche Bank's U.S. Equities Division in New York City. He was also the chief economist of C.J. Lawrence, Prudential Securities, and E.F. Hutton. He taught at Columbia University's Graduate School of Business and was an economist with the Federal Reserve Bank of New York. He also held positions at the Federal Reserve Board of Governors and the U.S. Treasury Department in Washington, D.C. He earned his Ph.D. in economics from Yale University in 1976, having completed his doctoral dissertation under Nobel laureate James Tobin. This is quite the resume, by the way. Previously, he received a master's degree in international relations from Yale. He completed his undergraduate studies magna cum laude at Cornell University. He is frequently quoted in the financial press, including the Wall Street Journal, the Financial Times, the New York Times, the Washington Post, and Barron's, to name a few, and basically all the ones that matter. He was dubbed Wall Street Seer in a Barron's cover story, and he appears frequently on CNBC, Bloomberg Television, and Fox Business. Please join me in welcoming Dr. Ed Yardeni.
Well, thank you for that nice introduction. The only problem I have with people kind of reviewing the jobs that I've had is it sounds like I can't keep them. Maybe I can, so I finally started my own firm back in 2007. I actually was working for a fellow out in Akron, Ohio after I left Wall Street, and it was called Oak Associates. It's still there. And Jim Olschlager ran the place, so we really had a lot of experience with him with managing money, and certainly enjoyed that. But 2007, we went on our own with Yardeni Research. I just need somebody to turn off that light. Well, no, never mind. I see. Otherwise, you won't see me. I thought it was the sun. So, anyways, forget what I just said. So anyways, went off on our own in 2007, and we had a little office on Madison Avenue. It cost me like $3,000 a month. And after a year, I said, you know what, everybody works from home. And so we've been virtual since 2007. So when COVID hit, I was basically telling everybody, welcome to our world. This is what we've been doing for a long time. And we're still virtual. Everybody works from wherever they like. And it's for us anyways, it's been a good model. It's not necessarily a good model for everybody because you don't have that interaction that you might have in an office situation. But anyways, it's been loads of fun. It's always, there's never a dull moment. I think we have a pretty good track record, but the past three years have been particularly good. And I'm going to share something with you. Besides my resume, let me tell you a little bit about myself and why I think we did so well over the past 3 years. And a lot of it had to do with my access to inside information. And so, for example, when the market hit its low on October 12th of 2022, my brother, who I don't talk to all that often, called me up and said, Eddie, should I get out here? So he always calls me at bottoms. Unfailingly. I mean, he was unbelievable at doing that. In addition, I do fundamental analysis, but I do pay attention to sentiment indicators and to technical indicators. But right around that time, the bull-bear ratio, which is calculated by a firm called Investors Intelligence, the bull-bear ratio was down to 0.66. That was the lowest it had been since the great financial crisis in 2008. And I was thinking to myself, things aren't that bad. But a lot of people thought there was going to be a recession. I didn't. We were kind of alone in that view. And I'll tell you why we didn't expect a recession. And again, inside information. Well, first of all, I do tend to be an optimist. That is something I've actually been accused of being a permabull, which I view as a compliment. Because if you look at the stock market over the many years, it usually goes up. So I wouldn't mind if on my tombstone it said Ed Yardeni was usually a bull and usually right. And I'm not saying that to brag. I'm just saying, you know, I mean, I think that's why Warren Buffett's basically gotten it right, or Professor Siegel has basically gotten it right. Stocks really are for the long run. If you trade them, then you have to not only get out at the top, but get back in at the bottom. And that's you know, those are two fairly hard decisions to make. And honestly, I've had more of my great calls calling bottoms than calling tops. Again, maybe that's because I'm too much of an optimist. But I think what proves that I'm an optimist is I have 5 kids. I did it with 3 wives. I mean, clearly, you have to be an optimist to do that. So the first 3, I don't recall them being really too expensive when they went to college. I just don't remember being stressed about it at all. But the last 2 was like insane. I mean, really, $500,000 or something close to that? I mean, what is that all about? And so now my 2 young kids are young adults. They're in their early 20s. And when they got out of college a couple of years ago, they're suddenly living with us again. So we were looking forward to being empty nesters, and we weren't. And when I'm reading in my research that something like 30% of young adults are living at home. And it's no wonder. I mean, it's ridiculously expensive to rent, and cost of living is extremely high. But after a couple of years, I said to my wife, I got to get them out of here. It's not good for them. You know, I know you love them, and I love them too, but they really should leave. And and by the way, you know, a lot of pollsters have been going around asking people how long does their paycheck last during the month. And they did get a couple of part-time jobs, each of them. And if you ask them how long their paycheck lasts, they said, you know, I don't make it through the end of the month. And this sounds like really depressing. What they didn't reveal is I pay their credit card. Okay, and so I think there's a lot of intra-generational transfers of income going on between baby boomers like myself. I'm 74, and so I'm a card-carrying member of the baby boom generation, and the kids. Now, the baby boomers like myself, what do we all do? We watched all sorts of TV, and one of the shows that was very popular was Star Trek, and Leonard Nimoy was Spock, and Spock, you know, often said, you know, live long and prosper. And we baby boomers said, hey, that's a great idea. Let's live long and prosper. And that's what the baby boomers have done. They've lived long, and the longer you live and stay invested or own a house, own stock, have your own maybe business, these things do tend to compound. They tend to increase in value. So the baby boomers collectively, all collectively, the baby boom households have $79 trillion in net worth, not billions, $79 trillion in net worth. It includes the value of houses, stocks, pensions. It also subtracts away mortgages and debt. But you know, a lot of what I see, again, inside information, I'm still working for a living because I got 5 kids. But my friends who only got married once and had 2 kids, their kids are long gone. And they've paid off their college tuitions and education. They've paid off their mortgage, and they're just sitting on this pile of money. And the only real uncertainty they have is how long they're going to live. They want to live long and prosper. But other than that, on average, the baby boomers have a tremendous amount of net worth. Again, they have the household sector, they have half of the net worth of the entire household sector. Guess what? The younger people will live long and prosper as well. And some of them will be fortunate enough to get a windfall when their parents pass away. You know, the younger folks are kind of say, Mom, Dad, I wish you a long life, but don't spend it all. You know? So that's kind of, that helped me to conclude that, you know, the consumers are going to surprise us. They're going to keep spending. They're not real interest rate sensitive. If you raise interest rates on baby boomers, they're happy. They don't have a mortgage, or else they refinance their mortgage at a record low. So maybe they need to downsize. But on the other hand, a mortgage of 2.5 to 3%. It's like, why would you want to give that up? So they're staying put, but they're traveling a lot. And not only are they traveling a lot, but they're going out to restaurants. I mean, what's the point of cooking at home when the kids are gone? So you go out, and before the early bird special, you go to the healthcare provider just to, you think I can make it up Machu Picchu in Peru? That's our next vacation. So they're all over the place. My wife and I have started a habit of traveling around the world, somewhere in the world for a week, twice a year. So we were in northern Italy just a few months ago. And then earlier this year, we were in Scotland. And it was really, really annoying. There were all these tourists there. I mean, they were everywhere. And a lot of them looked like they were baby boomers. So they're definitely traveling. And a lot of them, as I said, are probably providing down payments for their younger kids, helping them out. But to get rid of my two younger kids, what I did is I kind of gave them a hint. I said, look, I know your cars that I got you a few years ago aren't working so well. Why don't we trade it up to a better, not new car, but a new or used car? And so one got an Audi, the other one got a Subaru. They're both very happy with it, and they're gone. I don't know how it worked, but it worked. But what I realized is because I put them, I didn't really want the liability of them driving on my insurance anymore. I put them on their own insurance. And in New York anyways, it went up from 3,000 to 5,000. I mean, it's insane. Now, one of the kids moved to Boston, and after this, I'm flying out to Boston to go say hello. And don't come back, enjoy yourself. My daughter moved to Toronto, and I hear insurance is a little cheaper over there. So anyways, a lot of people were saying, oh my God, the consumer's going to run out of excess savings. You know, they got all these checks during the pandemic. Look at how the savings is coming down. They're going to run out of it. And they said they'd run out of it by October of last year. Jamie Dimon, the head of JP Morgan, was saying the same thing. He said, back in May of 2022, he was saying things look pretty good right now, but he was concerned that once the consumer ran out of this money that they had accumulated during the pandemic with the checks and all that, once all that ran out, you'd have a consumer-led recession. Instead, the consumers continued to spend. Let me tell you something I've observed about us Americans, and that is, when we are happy, we spend money. When we're depressed, we spend even more, if we have it. And certainly with the pandemic checks that were handed out, people had money. With some of the savings that occurred for a couple of months when we couldn't buy anything, people had money. And then I know everybody's complaining about how prices have gone up dramatically since the beginning of the pandemic. But wages have actually kept track of it. Wages have kind of gone up consistently with prices. And maybe one of the reasons prices have gone up is some of those wages went up along that. So believe it or not, for all the negative talk about the US economy, real GDP is at an all-time record high. It's the broadest measure of economic activity, all-time record high. Consumption, all-time record high. Consumption per household, all-time record high. Now people come back to me and say, well, that's not quite fair, looking at average, not median. Median isn't doing as well. And the rich are biasing that indicator to be up. And I tell them, look, the rich don't really eat that much more than we do. And maybe they buy more clothes and more cars and mansions, but they don't do that all the time. At some point, they have what they want, and their consumption isn't going to really skew the overall situation for the overall country. So, you know, Americans are depressed to a large extent because prices have gone up, and they still don't feel that the economy is all that secure. But the reality is, the economy's actually done very well. This is not a political statement. I've been saying this for a few years now. And I've been bullish on the stock market really since October 2022 because of the insight I had from my brother and a couple of other things. I didn't really see a recession out there, whereas you had all these, I call them the hard landers, the diehard hard landers. They just expected a recession in 2022. They expected it in 2023. They expected it in 2024. Now they're expecting the Fed's going to have to lower interest rates dramatically because that's what they've always done once they started to ease. But they always eased and started to ease when there was a recession. This time around, the economy's been amazingly resilient. Again, the consumers continue to spend. Baby boomers like high interest rates because not everyone wants to be fully invested in risky assets. Some people prefer to have some liquidity, and getting 4 to 5% is a pretty good return on a very safe asset. So lower interest rates might actually annoy some people who are, would like to have some money in their liquid assets. So where do we go from here? I think the market, we're in a bull market. I've been bullish, but I haven't been bullish enough. I mean, it's crazy. I was kind of viewed as delusional with some of my original forecasts on where this market is going, and I wasn't delusional enough. I mean, it's crazy. But so, for example, last year, at the beginning of last year, I said, I think we're going to go to 4,600 on the S&P 500. That was the beginning of last year. And we got there by the middle of the year. So I said, okay, we're ahead of schedule. I don't know that I really want to raise my numbers that much, but I'll go to 4,800. No, I stayed at 4,600. And then it came down because I expected a correction. We got it. And then it had the year-end rally that got us up to 4,800. So it wasn't that big a miss. At the beginning of this year, I had 5,400 for the S&P 500 by the end of the year. And we got there again a few months ago. So I raised it to 5,800. And by the way, 5,400 was right at the top end of the strategists. And so I raised it to 5,800. And here we are today. I forgot to tell you, the Dow's at 44,000, over 44,000. And the S&P 500 is over 6,000. So we're once again at new all-time record highs. Now, so again, where do we go from here? I think the bull market continues. Usually bear markets occur when you have a recession. And we, for the past 3 years, have a recession. We've had a recession that didn't happen. That was kind of my claim to fame over the past 3 years. Usually in the past, economists got credit for being one of the few to call recessions. Here, I got some credibility for saying we're not going to have a recession, and we haven't. So if raising the Fed funds rate, the interest rate the Fed charges banks from 0 to 5.25%, if that didn't cause a recession, and now the Federal Reserve is lowering interest rates, I know you had another fellow discussing the outlook for the Fed, but if now we're lowering rates, and we saw the Fed lowering the federal funds rate by 50 basis points on September 18th, and then they did it again this week. So we're down 75 basis points. So if the Fed's lowering interest rates, I don't think we really have to worry about a recession. What else could cause a recession besides tight monetary policy? Well, I guess it could be a geopolitical crisis. And, we got plenty of those, Ukraine, Russia, and the Middle East. And how does a geopolitical crisis impact the stock market and the U.S. economy? Well, in the past, it's usually been because oil prices have soared. Well, this time they can't, none of these things get oil prices to go up. And I think the reason for that is China is in a pretty significant property depression. And we know from our experience, we know from Japan's experience, that property depressions, once they happen, once the air starts coming out of the property bubble, that can really depress an economy. It can take several years for them to turn that around. I think today or tomorrow, very soon they're going to be announcing another fiscal stimulus program. We'll see if that works. But for now, China remains really quite weak, and that's depressed the price of oil. Also, they're driving electric vehicles, much more so than anywhere else. And so that's also depressing the price of oil. But that's a good thing for us. And now with this, with Trump 2.0, the president-elect is promising to pump, drill, baby, drill, to produce even more oil, more natural gas. And so that's clearly weighing on the oil market. Speaking of Trump 2.0, we just had an election and market absolutely soared on it. Was it all because Trump is the new president? Some of it was, but I think some of it was just a relief rally that this thing's over. It was just really, really annoying. And I think a lot of us feared that, my God, if the polls are right and it's really close, it could be no, not another contested election. Chad's on the floor and and everybody's suing and all that, and insurrections and all kinds of other horrible stuff. And that didn't happen at all because the results were definitive. And so this time around, Trump is not contesting the election results. Now, by the way, I'm thinking to myself, well, shouldn't this prove that maybe he was wrong about 4 years ago? I mean, if we just had just because he won it, but he won it fair and square, it's possible that things really were kind of out of control 4 years ago, and because of the criticism of the way it went, that everybody tightened up the way they conduct elections. But anyways, I think for the good of the country, it's good that our political system still works. Now, before the election occurred, I was bullish on stocks. I said, it really doesn't matter whether it's Harris or Trump. And my thinking was that we pay too much attention to Washington politics, fiscal policy, monetary policy, the Fed, yada, 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 to quote Steinberg. After a while, it kind of gets to be too much. But it's always making the headlines, and it's always seems to be a key factor driving the market. And I was saying, well, you know what? My attitude, and I've had this attitude for a long time, isn't it amazing how well the U.S. economy does despite Washington? And I point out that while politicians really don't work, and because they don't work, they got a lot of free time. And because they got a lot of free time, they say, well, I guess I'll be a politician. It's pretty good work. All you got to do is schmooze for a whole year raising money, and then pay off your constituencies, and you get a pretty nice lifestyle. You maybe even get rich. Maybe you trade some stocks and do well. But meanwhile, the rest of us working stiffs, we're working, and we're going to work every single day, and either as proprietors, as managers, or workers. And I think we really try hard to work hard to do what we do really, really well, for ourselves, for our families, for our communities, for our country. And I think we do an awfully good job of that. So again, I think it's us, not them. I mean, I love the president say, well, I just created millions of jobs. I, for example, just in May hired a younger fellow to help me out. And Eric Wallerstein is his name. He was a journalist at the Wall Street Journal, very highly rated, a lot of front cover stories. I liked what he was writing. And before that, he worked at the Fed for a few years on the desk. And so I hired him. Biden didn't hire him. I hired him. And so I think we do well despite Washington. I think we succeed working every day, realizing that Washington is meddling in our business. And that's part of what we have to do for business, is figure out how to deal with all that. And so it's conceivable, I mean, it's very likely that one of the reasons the stock market rally is not just because it's over, but because I think you have to admit or concede or be joyous about the notion that we now have a regime change to a pro-business administration. The stock market focused on the happy stuff that Trump has been talking about, which is cutting corporate taxes, great for corporate profit margins. I'm going to this weekend raise my profit outlook for the next couple of years, because we're going to get another cut in corporate profit margins. Deregulation looks like that's going to be a very positive impact on cutting the cost of doing business. But the stock market kind of tuned out, well, what about tariffs? What about larger deficits? Whereas the bond market, I think, is still kind of attuned to, well, tariffs could be inflationary, and the deficit could be a real issue in the bond market. But Trump very cleverly campaigned with Elon Trump. I call Elon Trump. It should be, they do seem almost like they were separated at birth these days. But If you haven't read Elon Musk's biography by Walter Isaacson, you have to. I mean, he's in our face every day now between Twitter and between Tesla and the Rocket Man, SpaceX and all that. And now, obviously, he's got a lot of political clout. He can just walk in and out of the White House as he likes. But he's basically taken on the task of cutting government spending. If he does that, he really is Superman. I mean, that'll be something to watch. But in the biography, there's like a lot of anecdotes about he's really, really into cost cutting. And so when he sells rocket, space on rockets to the government, he charges them a flat fee. It's not cost plus, which is the way the defense industry and Boeing and all these others. So he's very disciplined on costs. And there was one example where he got together with his engineer at SpaceX. And he said, "How much does this valve cost?" And the engineer said, "I'll look it up, $15,000. And Trump said, "This kind of looks like something I could buy in a hardware store and retrofit it if I have to." So it turned out that was true. And it cost $15. So, I think you see that in his mentality. There's something wrong with the guy, just the way there's something wrong with Trump. I think Trump is a narcissist, but then almost all of our presidents have been narcissists. I really think that we need to have a requirement of a psychiatric test for anybody who wants to run for president. And the focus should be, how did you get along with your father? Okay? Because the people who are the presidents who want to be presidents to impress their fathers, they screw up, or they're doing stuff that's satisfy their own psychiatric needs. I don't know what Elon Musk is supposed to have attention deficit disorder or something like that, but he gets bored really quickly. I mean, so he does Tesla. Okay, boring. Let's move on. SpaceX, and he's got Neuralink. He just keeps coming up with these. Now he's involved in reducing costs with the government. I think it's going to be it's a lot easier to cut costs when you're the boss of your own company than to cut costs of the government. But for now, we can't say for sure that he won't succeed. And if he does succeed, then maybe there will be cuts in government spending. And we know there's going to be tax cuts. Steve Mnuchin, who was the Treasury Secretary for Trump 1.0, I was asked on CNBC, what's Trump going to focus on? And he said he's going to focus on reducing taxes, which really means corporate taxes, and maybe taxes on tips, which who pays taxes on tips. But that's going to be something, and maybe overtime, which would be a big deal for a lot of people who work overtime. And then he's going to focus on tariffs, and he's going to focus on sanctioning Iran. So we'll see how that goes. I think the markets also have a perception that maybe it's all bluster, but maybe there's a better chance that Trump will, one way or another, figure out a way to stop the wars between Ukraine and Russia and in the Middle East. My pet theory is that when Biden told the Israelis, don't take out any nuclear facilities or oil facilities in Iran, the Israelis said, we won't. And they sent 100 jets over there, and they bombed the living daylights out of all the defense systems that the Iranians have, and they are completely naked. And so now that Trump is in, I think Bibi's going to call up Donald, and he said, I'm on first name basis with him, and he's going to say, we're going to take out the nuclear, the nukes in Iran. And I mean, is Donald going to say, no, wait until the sanctions? He might say, yeah, go ahead, give it a try. So things are changing in a big way on a geopolitical front, on a domestic front. And I think so far the vote by the stock market is a vote of confidence in the future. But again, I think we should have always had a vote of confidence, no matter who's in the White House, because one way or other, we do well despite them. So I think the S&P 500 continues to go up. It's ahead of my forecast. I thought we'd get to 5,800. Now I'm probably going to have to raise it to 6,000, which is where we are now. I mean, the valuation multiple is not cheap. You're not getting stocks real cheap. What I'm hoping is that the market kind of slows down and goes up with earnings. There is a chance here for a melt up, which is another bullish scenario, but it's not a long lasting one. But they'll be very reminiscent of the late 1990s. My base case, the most likely case I have is when I compare things to decades, is I think we're in the roaring 2020s, technologically led productivity growth, boosting economic growth, keeping inflation down, and being very good for corporate profits. The other one is the 1990s scenario, which is not my base case. So 50% roaring 2020s, 20% to a scenario where we have a melt up like 1999, and then another 30% for geopolitical risk and so the political risk, geopolitical possibly, and the other one would be domestic political, which is basically debt crisis issues. But again, I think that issue is still out there, but it's been put on the sidelines for now.